quick, smart, and disciplined.
When you increase liabilities, it's a debit to liabilities. Let's say $10. Cash?
Writing off the top of his head, it was incredible. I'm just sometimes sitting there in awe.
Oh, zero margin. Of course that makes. Of course it's going to be zero.
I'm probably smarter than you, so it's okay.
Jeremy, you talk about transparency. When did you let everybody know you're being paid every month by whatever stock was trying to have you pump and dump? Not gonna lie, guys, he's a lot more value oriented than he portrays on the channel.
I am very lucky to have that guy in my life.
Hey guys, it's Paul Gabriel here. We're gonna do some stock analyzer drill today because this is definitely worth $30 a month or $80 for day trading.
Welcome back to Strongman Personal Finance, everybody. In this video, in this live stream, you're gonna give me stocks, and I'm gonna do literally what Everything Money does. And what do they have? Like 100-something thousand subscribers? Let's go look at their channel. Let's go pull it up, see how Everything Money's doing. They're probably crushing it, you know? Because all you have to do is make it like a gimmicky tool. And then you just get hundreds of thousands of subscribers. And people think you're a genius. Yeah, look at that. 180,000 subscribers. They're blowing it out of the park, man. Let's see. Let's go check out the EM community. So while I'm looking around, you guys just start dropping some stocks in the comments. And we're gonna do DCF. Okay, we're gonna do a stock analyzer tool. Now, whatever number pops up on there, okay, you should not buy it based on that. Okay, don't. I'm just here to demonstrate this thing is probably pretty stupid. All right. So here we have Everything Money, $29 per month. You get their software, education, or $79 per month. $79 per month. Okay, 79 times 12. Almost $1,000 a year. Think about that. $1,000 you could put into your Roth IRA or your 401k. But instead, you're learning about options trading and chart trading. What a freaking joke.
He was actually signed up for us, guys. And he's a hypocrite. Yeah, he doesn't wear a shirt.
I'm wearing a shirt now, bussy. Huh? Yeah. I'm wearing a shirt, Paul. What do you think about that? Am I smarter now? Has my brain increased in mass? Yeah. All right, let's go ahead and do some stocks. Okay. First stock, Atus. All right, let's go do Atus. Atus, my master, you know what is. I don't even know what this is. What is this? Altice USA. Okay. I'm using my Paul Brilliance here. Altice USA, together with its subsidiaries, provides broadband communications and video services in the U.S., Canada, Puerto Rico, and the Virgin Islands. I think that's probably where Paul belongs. It offers broadband video, telephony, and mobile services to 5 million residential and business customers. Okay, let's go ahead and see how the stock has done over the last 5 years. Been absolutely annihilated. I wonder why. Okay, market cap of less than $2 billion, revenue of $10 billion, trailing, and net income of $639 million. Shares outstanding, 453. Let's go look at the financials. Okay, so looking at the annual financials, looks like they had a massive explosion in revenue from 2016 to 2017. Was that an acquisition? I don't know. We can look at the statement of cash flows. And ever since then, the revenue's been growing with inflation, basically. 2%. Well, inflation's higher than that now, but you catch my drift. And then the trailing revenue, okay. Oh, look at that. The revenue is it's basically flatlined or starting to slowly decline. So it's basically a zero growth company, at least on the top line. All right, let's look at some profit margins here. Woo! Look at this. Look at the year-over-year growth. It's getting worse. What's going on here? All right. Gross margin, 66. Okay, gross margin is roughly the same. Operating margin has started to deteriorate a little bit. And profit margin has definitely taken a hit in the last couple of quarters. Free cash flow margin is also down massively. So basically their revenue they went from very slowly growing to now it's declining. Their operating margin, their profit margin, and their free cash flow margin are deteriorating. Let's look at their balance sheet. balance sheets. Okay. Total current assets of 2.5. Total current liabilities of 3.9. Oh my God. Is that a normal current ratio for them? Let's see. Oh my God. Look at their current ratio. I guess they can make it happen. That's a pretty terrible current ratio. Your current ratio shows your compares your short-term assets to your short-term liabilities. Where's it at? There it is. Yeah, I guess they always run a low current ratio. I guess they maybe have a lot of turnover in their cash flow. I don't know. All right, let's go ahead and check this out again. So the current ratio is garbage. Okay, they have about $250 million of cash, 343 of receivables, and whatever this is, I have no idea. And then their short-term debts, they have, look at that. Their accounts payable is larger than their cash and receivables combined. What the hell just happened? Sorry, I don't know what just happened here. So they have a lot of short-term debt. Okay, that makes me uncomfortable, but they've been doing it for a while. And let's compare long-term assets. So they have property, plant, and equipment. They've been buying more every single freaking quarter, it looks like. Goodwill and intangibles. I don't know if that's goodwill or intangibles or both. Might be intangibles. Look, it looks like it's just being amortized. Okay. And let's see. So total long-term assets have been trending down. Looks like depreciation, amortization. Long-term debt is slightly under long-term assets. So basically, they don't really own any of their long-term assets free and clear. And hopefully that's not goodwill. I don't know. All right, let's look at their changes in stockholders' equity. Okay, so shareholders' equity has basically been in the negative. It's been absolutely destroyed since 2017. I mean, just look at that. Look at that decline in equity. Oh my Lord. I wonder what's causing that. I don't know. So retained earnings. Retained earnings is getting better. Okay. Do they just have like a massive write down or something? Are they? Yeah. Okay. They looks like they got wrecked in like 2020, 2021. All right. Let's look at the statement of cash flows. So basically their balance sheet's like terrifying. Okay. I mean, their equity's freaking negative equity. They're underwater. They have more debt than they do assets. Okay. Let's look at their cash flow. Operating cash flow is very, very consistent, or it's within, 600 million every quarter. Capital expenditures have been going up. Let's see. Debt paid. So they're paying back debt. That's good. Okay. But their equity's still negative. I don't know. This thing is kind of like a turd. I mean, basically everything in this company is deteriorating. Literally everything. But since I'm Paul Gabriel, we're going to do a DCF. Okay. Let's see. I don't even know what to do. Well, I say on the high end, okay, maybe they have revenue growth into the future of 2%. Okay, so we're going to go to our, well, first we input the information into my DCF. So we need trailing 12-month revenue. Okay, looks like it's collapsing. So trailing 12-month revenue is 9.799 billion. Okay. 0.600. 600. See, this is the only thing that sucks about not having the EM tool is you can't freaking just have the data. You got to actually find some data and copy and paste it in here. You know what I'm saying? So this is a 5-year DCF. So trailing 12-month is 9.7 billion. Let's look at their shares outstanding. Where is it? I guess that's 453. Yeah, 453 million. Okay. 453. Boom. Okay. So on the high end, they're going to have revenue growth of 2. Let's say flat revenue in the middle. And then we're going to do, I mean, who knows? This thing could just be like, this thing could start absolutely plummeting. I mean, look at the year-over-year growth or decline in revenue. -1, -2, -2, -7. But, we'll be conservative and do -2. Okay. Net profit. What is their profit margin? Well, recently it's been 3, 4, 8, 9. So it's been absolutely deteriorating. So I don't know. Maybe we can do 3, 5, and 7. Free cash flow margin is a little bit better. So maybe like, I don't know, 5, 7, and 9. PE at sale. What is their price to earnings ratio right now? Okay, their PE is freaking low. It's extremely low. You know what? Since I'm Paul Gabriel, I'm going to do 50, 16, 17. I'm just kidding. Okay, let's do 3, 4, and 5. Price to free cash flow. I don't even have that on here? Am I blind? Do I not see it? We'll do the same thing. Why not? Who freaking knows? Okay, what discount rate do we want? Well, I always want a 15% rate of return. So I would consider buying this stock. What is the stock trading at right now? I guess it's a buy. Okay. I guess if you buy it at $3.91 on average, you know, the average of the free cash flow in Gap DCF, you would get a 15% rate of return basically right now. Okay. Yeah, look at that. If you believe these assumptions, they can just magically turn around their declining revenue growth, you know, and that massive amount of current liabilities that they have relative to their current assets and their just absolute disastrous revenue. I mean, I don't know, maybe. Okay. So I get 3.91 a buy point, 6.93 for the middle, and 10.87 for the high. Okay. So at the end of the day, I don't know. I don't like it. What is it about this thing? What's so special about this one? Okay. Look at VEQT. All right, let me do my Paul Gabriel skills here. VEQT. What is that? VEQT. Let's see. VEQT. Man, get out of here. What is that? I can do a DCF on that. Nvidia. Okay, we'll do Nvidia. Oh, let's do Nvidia. Nvidia. Oh, yeah. Oh, yeah, Nvidia, baby. Oh, rub my nipples. Oh. Okay. So let's look at the income history of Nvidia. Wow. Now you look at this, right? So this is the problem with their software. Okay. Look at this insane revenue growth. So we have 2015, it's like 5 billion, right? And then it's 6.9 billion, then it's 9 billion, 11, then it's 10. Okay, it went down a little bit. And then it explodes to 16 in 2020. And then it goes up to 26. Like that is a massive increase in revenue for 2021. And then we have trailing 12-month revenue is 28. But we can see I guess it's starting to decline a little bit. I mean, I guess we'll see. But at the end of the day, I mean, like, if you think this is outrageously high and you think this is just a fluke, which it absolutely could be. I mean, they had revenue growth, right? But then all of a sudden during the pandemic, something changed and kaboom, the revenue exploded. But if you're using this DCF, you're literally using the trailing 12-month revenue and you're starting it from this exact point. So if you think revenue is going to collapse massively over the next couple of quarters or years, it's kind of hard to put that in there, okay? But you know what? Let's do a DCF on Nvidia because everything's going to work out perfectly, okay? So trailing 12-month revenue is 28 billion. Let's do, where's the shares outstanding? Shares outstanding, 2.5 billion. 2500. Okay. Oh, look, it's a buy at $1.55. We have Nvidia. Okay, so we have 28 billion trailing 12-month revenue. We have 2.5 billion shares outstanding.
Let's go ahead and put our assumptions in. Let's go do our assumptions.
Yeah, look at that insane year-over-year revenue growth, man. Holy crap. Man, they had an insane year. Insane year and a half. So before the pandemic, you know, it was growing pretty rapidly. these numbers right here, I think, are a fluke. I don't think they're going to grow at 61% and 52% going forever into the future. So you know what? Let's be very chill here. Let's do 10, 12, 15. Okay. You don't like it, you can call freaking Warrior. 12 and a half. This is a DCF tool. All right, let's look at the profit and loss. So net income, net profit margin has been, man, look at those. Woo! Look at the change in profits right there. So it looks like during like the height of the pandemic, I mean, they were raking in massive profits. And then their profit margin is like massively deteriorated. So let's see what their profit was before the pandemic. Okay, well, I see 12, 24, 31, 35, 25, 25, 36. I have no idea. We'll do 25, 30, and 35, because why not? 25, 30, and 35. Free cash flow margin. Let me punch in some numbers here. We'll do 20%, 25, and 30. 20%. And just think, this is all everything money has to do. Like, they literally have a huge freaking YouTube channel. And this is all they have to do. This is the easiest thing in the world. I should just do this in every video, man. I would get so freaking rich off of YouTube. All right, let's look at the PE ratio. Where's the PE ratio? Okay. Holy crap. Okay, so before, man, they have the PEs everywhere. Look at the quarterly. 57, 57, 58, 49. Woo! Look at that PE. Well, I guess we can do, I mean, we can be really insanely conservative. 20, I mean, even that in 5 years. 20, 25, and 30. Why not? All right, and then we'll just do the same thing for price to free cash flow. 15% rate of return. Are they doing share buybacks? Let's look at the statement of cash flows. Nope. Well, they bought back shares in the last couple of quarters, but I don't know if that's, yeah, that might have just been because they were flush with freaking cash, but they were definitely buying back some shares in the last couple of quarters. We'll just ignore that for now. Okay, so what do we have? What is Nvidia's stock price? 170. Okay, 169. 69 after hours. Well, if you want if you believe the 10% revenue growth rate, you would, and all these other assumptions, okay, you would buy it at $52. Middle, 85, and high point, 129. What do y'all think about that? Okay. Oh, did I screw up the free cash flow margin? Okay. So basically, according to EM's model, it's overvalued. I mean, honestly, this probably isn't a stock I would be interested in right now. Because just look at this revenue, okay? Something's off about that. That's not natural. Something this to me, it seems like it's a fluke. Obviously, there's more research you need to do. But when I see something that just okay, it was growing pretty well, okay, and then all of a sudden it explodes, it's like, is this a one-time thing? Was it the whole crypto thing that was going on that led to the revenue exploding and the demand for chips or whatever? I don't know. You have to do more research. But usually when I see something like that, I don't like it, okay? And plus, I buy index funds, so I don't really care. Let's see. Dude, is this the real Daniel Prunk? This is a kind of a troll video, right? I don't actually buy individual stocks. I'd love for you to check out the stock Unlock. All right, I will appease Daniel here, and we'll look at Unlock. Unlock my big fat, you know what? Unlock. You trolling me, boy? Unlock stock. What is he talking about? Am I reading this right? Out stock Unlock. Is it stock Unlock? What is this? Are you shilling your stuff? What is this? We analyze and score over 170,000 global stocks and ETFs. 14-day free trial. How much do they charge for this? Okay. Well. Oh, yeah, you're shilling your stuff, boy. I see you right there. I mean, it's cheap. I mean, it's cheaper than everything money. I can tell you that. I don't know what they give you here. I don't know. Man, run a DCF. I could do a DCF. Okay. Look at you, Daniel. You shilling yourself. All right. Anyway, we're back to stock picking. Atkore. Atkore. What is this? Let's see what this is. ATKR. ATKR. Atkore. No idea what this does. Engages in the manufacture and sale of electrical safety and infrastructure products in the United States. It offers conduits, cables, and installation accessories. Now, remember, ladies and gentlemen, I am an expert in this industry. Okay, I know everything about conduits and cables and installation accessories. It's my bread and butter, basically. Okay. It designs and manufactures safety and infrastructure such as metal framing, mechanical pipes. I'll show you a mechanical pipe, perimeter security, and okay, whatever. Okay, so what's happened to this stock? Man, this thing is mooned. It's mooned. Why is it mooned? Infrastructure. Does this have to do with the housing market? I mean, I would imagine so. Like this is pretty insane. Let's see. Well, I'm not going to read the financial reports because this is an everything money analysis, okay? So let's look at the income statement. So we're going back in the past. We can see their revenue was, it was growing, and then it took a hit in 2020, and then it massively exploded. Uh-oh. See that? Now, does that look like a fluke to you, ladies and gentlemen? Does that look normal to you? I don't know. Let's see. Well, I'm going to jump straight to the cash flow statement, see if they did any acquisitions. Okay, they had a big acquisition in 2022, and they had another one in 2017. Okay. And yeah, their revenue did jump. So basically, their revenue was declining, and then they acquired something, and then their revenue started going up again. And then it started declining again in 2020, and then now it's blown it out of the freaking park. Okay, and they had a huge acquisition. When was that? In 2022. So maybe that's contributing to their revenue growth year over year. I don't know. I don't even know how you would value this thing, man. This is one of those stocks you'd really have to do a lot of research. I mean, yeah, their fiscal year ends September. So, yeah, with the full 2020 year. Okay. I don't know. I'll just throw these. I'm going to throw some numbers in the calculator. I have no idea, but we'll throw some numbers in there and we'll see. That's how we do it here, okay? 3.913 billion. Comma 95. Comma 95. This really is easy. I need to do this more. Let's see. Shares outstanding. 41. Oh, looks like they're buying back some shares. Okay. 41,320. Okay. And what's this ticker's called? Atkore. Okay. So I have no idea what to put in for revenue. So I'm just going to grow it at the rate of inflation for the low. Normal rate of inflation, 2 to 3. And then we'll do 5. I'm just pulling numbers out of my ass, by the way. Profit margin. Do they even make money? Let's see. This is the EM life. Yeah, look at the change in profit. 3,577,8 2023. Well, I don't know. Let's do low end. We're gonna do. God, I have no idea. Let's do 8, and then we'll do 15, and then we'll do 22. Why the hell not? Okay. So free cash flow is lower. A little bit lower. So we'll do 6, 13, and 20. All right, PE at sale. Let's go. You see how hard this is, guys? I mean, once you have the tool, you can literally just punch in the numbers. Oh my God, their PE is super low. That's pretty terrifying. Okay, so you go, you look, you're like, okay, this company's been growing, has had explosive growth in revenue, but now their PE is super low. It's like, oh, their PE is low. That means they're cheap. Well, I think the market's expecting their future earnings probably, or their revenue earnings probably aren't going to be that great. That would be my impression. Let's see. But so this tool is probably totally freaking meaningless because if their revenue starts to collapse, I mean, this tool is going to be massively wrong. I mean, look at these year-over-year revenue growth rates. This is no way this is sustainable. It's insane. Whatever. Okay, we'll throw in some PEs. We'll do, what do they always do? 12, 15, and 18. 12, 15, 18. Discount rate. Okay, so are we buying this stock or not? So it's 123. See, 70, 177, and 330. This means nothing. Okay, this is a stock you need to do a lot of research on because something's fishy here, and I'm pretty sure with this low of a PE ratio, it's probably not going to last. Okay, and honestly, this thing's probably going to bubble. I mean, look at this. Look at the market cap before the pandemic, and then look at it now. Okay, it's like 3x in market cap. This thing is probably going to bubble. It's just obvious to me. It's like, oh, look at it. Oh, wow, yeah. That's not going to come down at all. Look what it was trading at before the pandemic. Okay, so before the pandemic, it was at $40. And then now it's at 123. I mean, I don't know, man. I would stay away from that thing. That's my personal opinion. Let's see. PPETF. Did you see the Graham Stephan tweets or Lafufu's new video stroking Elon and Tesla? Oh, dude, do we want to do a Tesla DCF? Okay. Let's do a Tesla DCF. Why not?
Tesla! Yeah, it's gonna grow, bro.
I'm going to show you how stupid these people are. Okay, Tesla. Let's see. So, Tesla, oh man, their market cap's really come down. It was over $1 trillion at one point, wasn't it? I mean, like everybody's like, oh,
Tesla's the future, bro. It only goes up.
and it's down 46%. Like, it's just been absolutely wrecked. Okay, let's do trailing 12-month revenue, $74 billion. Tesla, my Esla. There we go. All right, so here's Tesla. 74 billion TTM, shares outstanding.
Woo, they're issuing shares? No way.
We'll use the diluted, it's the same. 3.146 billion. 3.146,000,000. Okay. Tesla, my Esla. What are we going to do for their revenue? So their revenue has been absolutely explosive, okay? So let's do, on the low end, we'll do, just to be nice to the bulls, okay? We'll do 30% low, 40% middle, and 50% high. I think most bull shitters can agree with that, all right? Let's look at the net and the profit margin. Yeah, let me look at the quarterly. Okay, so recently their profit margin it's been going up every single quarter, man. Look at that. Look at that. Woo! Woo! So that's tough. We'll do 13, 14, 15. Okay? You don't like it? Call a freaking lawyer. Free cash flow margin's a little bit lower, so we can just say 10, 11, and 12. Why not? Now the PE. Tesla's PE. Let's see how much their PEs come down. So it's definitely massively decreased. Okay, I mean, look at the PE ratio not too long. It was 300, 500, 192, 132, 73. And you got to remember the PE ratio for this tool is in 5 years. What will the PE be in 5 years? So it could be, let's just be nice to the bulls. We'll say 15, 18, and 21. And then we'll do the same for price to free cash flow. And we want a 15% rate of return. Okay. So, according to this tool, if you buy Tesla at 95 or under, or exactly 95.84, which it needs to be cut in half, you would get a 15% rate of return, assuming all these assumptions are accurate. Now, on the high end, Tesla My Esla is a buy right now for a 15% return, assuming revenue grows at 50% per year. And when you actually sell the stock in the future, it's going to be between 455 and 569. But we need to go look at the calculations, okay? So on the low end of revenue growth, what we're saying is Tesla's revenue in 5 years from now will be 277 billion. Not insane, okay? Not the most insane thing in the world. Probably still pretty high, and I don't think it's going to get there, but that's not insane. However, if we grow their revenue at 40%, now their revenue is going to be 402 billion in 5 years. And if we go to the high end, their revenue will be 568 billion in 5 years. That's like double the size of I think that's Toyota and whatchamacallit, Volkswagen combined. Tesla. It's ridiculous. It's not going to happen, okay? I'm telling you, what's going to happen is this whole growth 30, 40, 50, something's going to happen. Like they're going to hit a brick wall with revenue growth, or it's going to massively decline, and that's going to radically change the assumptions. I mean, if you change revenue growth to 10%, I mean, look at that. That's an absolute collapse. The buy point's now 44 to get a 15% rate of return. I don't know, man. I don't know. But you know what? I'm stupid. All right. Getting my pay, my due. Would love to hear you tear up Carvana. What's your best guess when they file for bankruptcy? All right, we'll go look at Carvana. And then we got another donation here. We'll get to that. Oh my God. All right, I'm gonna have to skip all the regular comments just to get these super chats. So we're gonna do Carvana. Carvana. My mama. I'm not even gonna do the DC up for this. Okay. So, oh my God. Look at that absolute obliteration, man. I mean, that's good Lord. Like a little dip advertisement. Actually, I don't know if you guys knew this. I'm quitting dip. It's day 4 right now. Okay, so Carvana, our e-commerce for buying and selling used cars. Great. Let's look at the financials. So they had explosive revenue growth. Okay, their revenue is just absolutely blown it out of the water. I mean, look at that. Holy crap. And obviously, I guess, they were making bank during the pandemic because used car prices went absolutely insane. But now interest rates are going up. So I think the whole used car market's getting absolutely wrecked. I keep hearing about this, the bubble in the used car market getting popped. I mean, obviously that wasn't sustainable, especially now with interest rates going up. There's no way these car prices are going to stay where they're at because people just can't afford it. But like, that's an insane run up. All right, then we have the trailing 12-month. I mean, their revenue is growing. Let's look at the quarterly. So, yeah, their revenue was massively growing, and now it's going to start, maybe trending down a little bit, which is fine because they had a massive run up in revenue. But that's not what people are worried about. I mean, their revenue is fine, okay? I think people are worried about the balance sheet more. So let's look at the balance sheet. Assuming this is accurate, all right, they have 1.3 billion in cash and short-term investments. They can, short-term investments, they could easily sell those. Just sell them, convert it to cash, pay off bills. All right. And 359 million of receivables. So you can be very strict or you can be very loose, like the cheerleader that you lost your virginity to. So you could look at total current assets and compare that to total current liabilities. That's fine. Okay. Their current assets are way more than their current liabilities. So that's fine, I guess. But if you compare their more liquid assets, like cash equivalents, and receivables, well, in that case, it's about 1.6 billion on 1.8 billion. So then it becomes a lot less good, because if they have trouble clearing this inventory, they're going to run into issues. So let's look at their historical current ratio. Their current ratio has gone up. I wonder what their quick ratio used to be. I mean, it's not the worst current ratio in the world. You know, the current ratio is obviously looking good, but remember, the big part of that is inventory. So if they have trouble churning this inventory, that's going to cause problems. All right. Long-term assets, 5.1 billion. Long-term liabilities, 7.3. So they are underwater when you compare their long-term assets to their long-term liabilities. That's not good. That's like having a house that's your mortgage is greater than your house. That's basically how I kind of imagine that. Okay. So current ratio is not the worst, but they're underwater when you compare long-term assets to long-term liabilities. They're packing on long-term debt. I mean, look at that. They doubled their long-term debt in the last couple of quarters, probably because it's a cash flow issue. We'll see. And we can see the common stock account is going up. That tells me they're issuing shares. And we can see their retained earnings is getting more and more negative. They're suffering losses. Okay. Let's look at the absolute destruction of their shareholder equity. Yeah, they probably had a massive share issuance. Let's see their liabilities. So their liabilities are massively exploding. We can see that. And then their assets are, I guess they're kind of growing with it. Let's see how they're getting their, let's see where their assets and stuff's coming from. Cash flow. Cash flow. Okay. So we can see their cash flow from operations. It's kind of all over the place, but they've had negative operating cash flow for the past couple of quarters, except for one. Okay. So right off the bat, you can see this business is just burning cash every single quarter. You say, oh, well, they're growing their revenue. But like if I actually looked into this and I saw all these negative numbers for operating cash flow, I wouldn't be happy with that, because they're obviously burning through cash. So the last quarter, they burned almost $100 million in operations. And God, look at this. They burned over $1 billion in one quarter. In the quarter ended December 31st, 2021. Okay, so they're burning cash pretty significantly, and they have to do capital expenditures, maintain their stuff. And they did a huge acquisition, okay? I don't know who they acquired. So overall, their free cash flow is like negative 188. And let's see. Yeah, they had a massive share issuance to buy something. That's what they did. They went into debt and they had a share issuance and they bought something, basically, because their core business is not providing positive cash flow. So they have to generate cash flow from investing activities, like selling property, plant, and equipment, which they haven't been doing, or selling investments, or basically they're funding their business from debt issuance and stock issuance. That's what they're doing. I mean, recently their cash burn hasn't been as bad. I mean, they were burning cash hand over fist, earlier in 2021. Their cash burn has slowed down. I don't know what next quarter is going to look like, but assuming, let's say they have to spend roughly 200 million in free cash flow, operations, and capital expenditures, maintenance. If they're spending 200 million a quarter, okay, they would theoretically, be able to survive, assuming nothing else changed for, I don't know, a couple quarters, maybe a year, more than a year. I mean, I don't see imminent bankruptcy, but I would definitely be concerned about this current ratio, and I would be concerned about their inventory, and I would definitely be concerned that they're freaking underwater when you compare their long-term debt to their long-term assets. Okay. So maybe this doesn't tell me the whole story. I don't see bankruptcy as imminent, but who freaking knows? Take a look at their 10Q. Carvana 10K. That'll probably tell us a little bit better. Sometimes, like if you really want the answer, you got to look at the actual financial statements. All filings, quarterly reports. Okay, here we go. This will tell us a little bit better. Balance sheets. Okay. Yeah, their current liabilities went down. Their current assets went down a little bit. And their total assets went up. You know what the concern could be? Maybe it's this long-term debt. I don't know when this long-term debt matures. Okay, here's the long-term debt. Okay, so their notes aren't even maturing for a couple of years. And the big one is a 2030 note. I mean, I'm looking at unless their like operations or their financials massively deteriorate. I don't know. I don't see like cash and cash equivalents. Okay, it actually looks a little bit worse when I'm looking at it from this perspective. But what did this tell us? Okay, they said short-term investments were 835 here. Where are their short-term investments? Finance receivables held for sale. Yeah, their balance sheet's a little concerning, especially their short-term, because they have 316 million in cash, 161 in restricted cash. I don't know what that's for. And they have receivables of 359. But they have short-term debt of 1.8 billion due in the next year. That is a little concerning. Okay, because if you exclude, let's say we exclude inventory from their current ratio, 4469 minus 2577. Yeah, they would be underwater, or they basically have a current ratio of 1. So I don't know. This is kind of a risky balance sheet to me. I'd be a little concerned, but I'm not invested in this, so not my problem. So honestly, I can't tell you if it's actually going to go bankrupt. I mean, they could always just issue more shares or go into more debt. I mean, if they issue shares, they're going to have to issue a lot, so it'd be a massive dilution event. But yeah, I don't know. Unless some new information's come out that I haven't heard of, I wouldn't touch that garbage. Is stock analysis better than Yahoo? I like the stock analysis one better, but you should always verify because sometimes the information could be wrong. TSM. Okay. TSM. Taiwan Semiconductor. China risk. Oh, God. Oh, I don't know what this currency means. I guess that's Taiwan dollars. Oh, dude, this is going to kill me. I don't even know what to do. Because I have to, like, convert the currency. I mean, we could look. Oh, my God. I wonder if Yahoo Finance has this in, like, oh, God. See, the problem is, so if you look at the currency, the stock is in USD when on the website, but the currency and the financial statements are in Taiwan dollars or whatever it is. Let's see if these financials are in USD. Oh, that's in Taiwan dollars too. Oh my God, dude. What have you done to me? I mean, I can just look at it from a overall standpoint. I mean, so the biggest risk with this one, of course, is China invasion. I mean, that's what you need to worry about. But they've had pretty significant revenue growth. Let's go back to stock analysis. I actually like that interface better. Because I would have to convert this revenue. I honestly have no idea how to do that. Or I'd probably screw it up. So, I mean, they have like great year-over-year revenue growth. I mean, look at that. Their revenue is growing very consistently. Yeah, the revenues exploded in 2020 and 2021. Okay, because I mean that coincided with all the the other chip companies blowing it out of the water. Now, is that going to revert? I don't know. You'd have to do your research, but I mean the revenue absolutely freaking exploded over the last couple of years, and even trailing, it's still growing. So they're doing pretty freaking good. Okay, they're definitely doing well. Let's look at their gross margin. So their gross profit has, stayed around 50, gone up a little bit above that. Operating margin has gone up. That's good. Profit margin has roughly stayed the same, gone up a little bit. Free cash flow margin has actually gone down. I don't know if they're doing more expenditures or what. But overall, this is a highly profitable business. It's just the pain in the ass is I don't have this in like USD. All right, we'll look at the balance sheet. Oh, God. We'll just look at the current ratio. All right. So current ratio solid. It's actually increased. Price to books, the stock has gotten cheaper over the last couple of yeah, look at that. Look at the price to book. So you can see the price to books, before the pandemic was, around 4, roughly, maybe a little bit lower. And then there's that massive run up to like 8 or 9, obviously a bubble, and now it's come back down. So it looks like, when it comes to that valuation, at least, it's trading a little bit better than it has before. And it's definitely, yeah, look at that collapse in market cap. Holy crap. Yeah. PE, it's actually lower than historical. Okay. Price to sales. So, yeah, if you look at it from those fundamental metrics, it's cheap. You know what I'm saying? I don't know. I don't hate this stock. But it's all about the future. It's like, will the revenue keep growing like this? I don't know. Will China invade? I don't know. But I mean, like, it seems like there's nothing I can really hate on this business about. The profit margin, all the margins are increasing. You just got to worry about Papa Bang. Okay. That's kind of my thoughts. It's definitely cheaper than it was before. Ridiculous. Redonkulous. Review Joseph Carlson's story fund portfolio. All right. I don't even know where to find that. Joseph Carlson story fund.
You want to see my story fund, guys? Sign up for my Patreon, bro.
I don't even know where it is. Where is that story fund? Do I need to access his Patreon to see it? Oh, my Lord. I'm trying to find it, buddy. Joseph Carlson story fund. If I can find it in the images. Okay, well, I'm going to assume it's this. All right, let me share my screen. I'm just going to assume it's this. So let's do a review. Is it VT? No, it's hot trash. Okay, here it is. Yeah, I don't know if this is exactly it. I remember the story fund had a bunch of like really large cap growth. Joseph Carlson story fund.
You're being tricked. Oh my God. Oh my God.
Where's your story fund, dickhead? Let's do a portfolio review.
Revealing my dividend portfolio.
Debunking dividend lies. Yeah, dude, I don't know where his story fund is. I mean, I just remember it being large cap tech. Okay, he had a bunch of large cap crap in there. And I think he was down massively. So assuming it's this, okay, Amazon, Amazon, I don't know what to think about that company. I mean, it's a large part of VT. I would never buy it individually. I mean, the thing with Amazon is they're making massive investments now that could potentially massively pay off in the future, but that's a long way out. Costco, I remember looking at that. That thing just seems super expensive. I mean, it keeps going up and they keep improving margins or at least growing their revenue, but it just seemed really expensive to me. Netflix, I mean, I don't know. Really not my type of stock. I think there's a lot of competition out there in the streaming industry. Apple, largest company in the U.S. stock market, or I think in the world. It's like, okay, you already have that in an index fund. Home Depot, don't really have any thoughts on that. I haven't looked at it at all. And Wells Fargo, okay, a random bank. Doesn't Wells Fargo have like a terrible reputation? They seem like a bunch of scumbags. So overall, it seems like he's buying a bunch of pricey stuff that you could normally get anyway in an index that pretty decent representations. I don't know. I don't see the appeal. And then he had Baba, which is the best stock in the world. So, okay, I'm about to close this out. ATKR was an 8-pillar stock. Yeah, I don't know, man. Something's up. Something ain't right. Something smells fishy there. You have to do more research. Let's see. This guy bought Tattooed Chef. Kid, just give up, man. Okay? All the freaking trolls are in the comments. PCO Bay is limited. Also, Home Depot sucks. Home Depot is the worst stock in the world. There's no other stock worse than Home Depot. Home Depot is how you lose money. Okay, we'll go look at Home Depot as the last thing. All right, we'll do an Everything Money DCF. Home Depot. Home Depot. The Home Depot. At least it's in US dollars. I like that. Look at that revenue, man. Pandemic did them good. Look at that. Woo! Look at those pandemic gains, baby. Is that going to continue? I have no idea. Let's see. Yeah, I mean, they definitely got a nice little bump during the pandemic. Look at that steady like revenue growth. I mean, isn't that pretty? It's like it just goes up with inflation, basically, or probably maybe a little bit higher. I don't know. When the pandemic, it just blows up, and then it slows back down again. Okay, so we're going to do an Everything Money DCF, and this is the last thing we're going to do. So they made 157 billion. So we'll throw that in here. Okay. Damn, I didn't realize they had that much revenue. Wow. Because Walmart has like 500 billion. I mean, I guess that makes sense. No, the housing industry is pretty big in the U.S., and I don't know if they have international or not. I've done zero research on this, but we're going to do a DCF. Okay, what's the profit margin? Wow, that's pretty predictable. 10, 10, 10, 10, 10, 10, 10, 10, 10, 10, 10, 10. Okay, so we're going to do we'll do 10. You know what? We'll do 9, 10, and 11. Why not? All right, revenue my revenue growth. What's a revenue my revenue before? Basically beat inflation by about 4%. Okay. So if we assume inflation is 3% in the future and they beat it by, okay, we'll say 7, 8, 9, whatever. Okay. Free cash flow margin. What is our free cash flow margin? 10, 9, 9, 10, 12, 9. All right, we'll do 8.5, 9.5, and 10.5. 8.5, 9.5, 10.5.
PE at sale.
What will their PE be in 5 years? Okay, 20, 28, 18, 22, 22, 22, 17. You know what? We'll do 15, 18, and 21. That seems okay to me. All right, discount rate. I want a 15% rate of return. So what do we get, ladies and gentlemen? What's the price of Home Depot? Oh, my Lord. Oh, wait. I'm an idiot. I didn't change the shares. I was about to say, that doesn't seem right. Okay, they have Okay. Yes, you got to make sure you change the shares. That's actually pretty important. There we go. That seems a little bit better now, doesn't it, ladies and gentlemen? Okay. So we got 189, 251, and 326. I mean, I don't know. Maybe it isn't so insanely overvalued. If they grow their revenue at 9% for the next, which if we have high inflation or higher than normal, that's possible. And they have net income of 11. I mean, they're pretty consistent with their profit margin in the 10s, 9, 10, maybe 11. Yeah. And their PE is 21. And you want a 15% rate of return. I mean, if you want a 10% rate of return, I mean, it's probably a good deal right now. I don't know. I'm just saying. So not as massively overvalued as I thought it would be, according to the EMDCF tool. All right, that's it. I'm freaking tired. Strongman is impotent. Breaking news. Yes, I'm impotent. I don't work. All right, guys, I'm tired. I made enough videos today. We'll do an EM outro, and you guys have a wonderful night. And by the way, everything I did, you need to do more than that, okay? Or you could just buy an index fund. Anyway, talk to you later. Cheers!
I'm Paul. I'm a value investor. Return on equity is assets minus liabilities. A lot of
Oops.
this conservative to get. The stock is currently at 182. The low price is still higher than the current price. I'm a buyer.
Oops.
I'm Paul. I'm a value investor. But the real true investor is the one that does well during a bad time. I have BABA, Carnival Cruise Line, Farmers Bank, HPQ, Intel, Facebook, Miller Knoll, Sleep Number, Smith & Wesson, Steelcase, GDX, GDXJ, and Walgreens.
Oops. I don't pay attention.
So you never know who's naked, and I rarely say too hard.
I think my dad finally feels I'm not a failure.
I think so.
Because of everything money, you think?
Yeah, probably because of everything. No, everything money, he thinks I'm not a failure.